Okay, good evening, everyone. Welcome to another ACY Securities webinar. For some of you here who may not have attended these webinars before, my name is Alistair Schultz and I'm the Chief Market Analyst for ACY Securities. And as a part of my history, I've spent about 15 years trading on the floors of New York, as well as in a variety of other investment houses and groups, and of course in brokerage houses as well. So tonight I really am aiming to give you guys a bit of wisdom from my own sort of experience when I first started. And for some of you who have attended my other webinars and may not have attended one that is this specific on what is really the market, then this might feel a little bit basic on the element side of things, but I can assure you that it's more about the theory side of things, about what you need to know about what it's like actually being a trader and some of the things that you might need to consider before going on that journey to learn how to trade. So the first things to sort of get underway and under wraps is I usually always give a warning about a risk disclosure warning, which is freely available in our PDF statement. In the slide deck that I've got tonight, I don't actually have that on hand, so I am just going to give you the general, trading is a risky business and that you should be looking at your assets and how it might fit in with your risk profile. And if trading is actually right for you, a full copy of our PDS is available on the ACY website. And if you need a copy of that, then feel free to shoot me an email or to give me a few moments and I'll sort of get source one for you. But I'd rather just sort of skip into it. I mean, tonight is really about some of the elements of trading and the theoretical side of things that are important to understand as to why markets might move and what goes on within them. So to get off right off the bat, I'm going to talk about what the market actually is. Now, some of you may already know what it is, but when it's stripped back to the bare basics, the market is really just an auction. It involves one party trying to sell something and another party or another number of parties all competing with each other to buy what is offered for sale. In the past, auctions have occurred in the open outcry of a pit exchange. So what you would see on the floors of Wall Street in movies and of course in real life, it's not so much the same today. But traders used to stand around shouting offers to buy and sell at prices that they had called. And like any other auction process, over the last sort of 30 years, these venues have sort of been replaced with electronic trading. So, there's a number of different examples of this, but to give you guys a bit of back history about, how long it's taken in time for the closure of exchanges around the world to move into electronic trading. The London Stock Exchange first moved to electronic trading in 1986. And then we had a number of others going through between that, including, Borsa Italiana, which is Italy's stock market, the Bombay Stock Exchange, the Colombo, the Toronto, the International Petroleum Exchange, which moved to electronics in 2005, the Minneapolis Grain Exchange, or the MGEX, for some of you, if you might recognize that, was in 2008. And the New York Mercantile Exchange, or NYMEX, didn't move to until 2006. So on the whole, though, we have seen FX markets readily turn into electronic trading quite early on. But there are a number of different participants that are actually involved in the market. So in the open outcry environment, it used to be registered traders working for brokerage firms, and they were providing buy-sell services for their clients. Clients were usually individuals, companies, or institutions with sophisticated understanding of financial affairs, and they were all that traded in the market. When it comes to today, we've seen that electronic trading has really opened the door to be accessible to a much wider audience. So all the original participants are still involved, but now we're seeing that, brokerage companies provide trading connections to almost anyone on the planet who is capable of depositing funds and able to actually place trades. So what we're finding is that it's attracting a much larger pool of participants whose level of financial sophistication is lower than what the traditional participants were. Most of these guys have had little exposure or training that might help them to succeed, but it contributes to a high failure rate of new traders that are hoping for big success. And unfortunately, when it comes to trading, there is a high rate of failure. But to be noted, there isn't a difference between the high rate of failure in opening a business or any kind of other industry, whether it be in construction or anything else. There is still high failure rates above 95%. Most people don't make income in their first sort of 12 months to 2 years. And sometimes that's even longer, depending on what the business is set up to be like. So the most common element that we always see when it comes to people new to trading or retail traders sort of trying to get runs on the board is that they don't actually treat it as a business. They treat it as a side hobby or something that they might be able to make a quick buck out of. But moving on from that, I'll come back around to that. But what I've got next is sort of talking about what traders actually see. So I want you to imagine yourself sitting as a trader in front of your computer screen, watching prices move on your chart. And I want you to sort of consider just for a moment, to think about what are you actually seeing. Many traders sort of forget what's actually happening in the background, that whole idea of the auction process. And they are looking at the idea that it's just tracking the movement of price. A lot of people will say that they read and they are observing the measure of fear and greed of all market sort of traders involved in the market. But it's really the market is still an auction. So we have to remember that. Most people understand how that auction process applies. And usually it's more easy to understand when it's applied to something that's tangible, like a house. You can have multiple bidders competing against each other to arrive at the highest price that one of the bidders is willing to pay for that house. The market's auction process is basically the same, except it's a little bit more dynamic. It involves large numbers of buyers and sellers providing constantly changing cycle of supply and demand. So if there are more buyers than sellers, the demand will be higher than what the supply is, and price will generally rise. If there are more sellers than buyers, then supply rises against the demand and the price will fall. The really easy example to sort of make this relationship up to is if you think about oil prices and what we're seeing right now with Brent and WTI oil prices in crude. If you consider that they're putting a big influx of oil into the market and they're increasing the amount of supply available, then naturally the price of oil is going to fall. So now that we're seeing that we're having meetings and discussions with OPEC that they're talking about cutting the supply of oil by more than 1.5 million barrels of oil per day for each nation of the OPEC nations, then we are likely going to see a rise in price. So let's sort of consider that original question I said again. What are you watching when you were studying your chart, looking for an opportunity to trade? The answer is you are monitoring the change in price that is occurring because of changes in supply and demand. The distinction might not seem all that significant, but it is essential to sort of understand if you are to be a participant in the auction process of the markets. If you believe you are just looking at a graph and don't understand what is really going on behind the scenes, then you may not understand why other things are happening during that trading process. And this applies to many elements of trading, especially common misconceptions about stop losses and why they don't always get respected. So this is a common issue for many inexperienced traders along the way. Now, as something to sort of consider while you're going through that process, there isn't, and it's important to understand why supply and demand on price is essential for why prices move. So it might be, if you wanted to do your own homework after this webinar today, a part of it could be, researching the impact of tightening and loosening supply on price in different markets and situations. It'd probably be a good idea for you guys to focus on things that you might know about already. So for example, real estate, but there are many other concepts that are easily transferable. So do some research into that sort of area and you'll sort of find how it may have evolved over time. Now, the next sort of area we're going to move into tonight is about how traders make decisions. So traders make profits and losses by forming a theory about whether price will move higher or lower, and then testing that theory by placing a trade. There are as many ways to formulate a theory about trading as there are traders, but you can break it down into several broad approaches of trading. So the first approach that you can look at is the technical approach. So this is technical traders who generally use mathematical models to make sense of markets price movements. The models fall into several groups though. You have sort of price action, which is where you are using price action itself in the most basic of technical analysis, and it involves examining price charts and forming a theory based on the patterns of individual price bars or the pattern formed by a series of candles. Then you'll have indicators, and indicators are known to all technical traders and use defined equations or mathematical formulas to create a secondary chart that attempts to create more predictive view of the market. You then also have support and resistance, which a trader will identify the historical prices where prices seemingly stopped and reverse to form resistance or support. Areas of support and resistance can be identifiable, and an identified support or resistance level may be important when price moves to an area on multiple occasions in the future. So technical traders really do tend to fall into two camps. They all use those sort of different algorithms or the price action indicator, support and resistance. They all use those sort of skills, but they'll fall into either one camp of being a systematic trader, who are sort of people who create well-defined trading systems or trading rules, and they allow for a history of trading results based on past data. So it's assumed that the results will be capable of being repeated from looking at what's happened in the past. They might also be discretionary though. So a discretionary trader might monitor the price charts to identify patterns that they will predict will be profitable. So technical traders using a discretionary approach will have more difficulty pointing to a theoretical history of support and potential future results. On the other hand, though, they tend to also be more flexible and will be able to adapt their approach to changing market conditions. So if you were a systematic trader and you came up with a defined system of parameters that said, this is when I'm entering, this is when I'm exiting, this is where my stop loss goes when I place a trade, this is where I'm going to be looking for a take profit, this is my risk reward ratio, those sort of traders tend to find that when a market changes, they are unable to sort of adapt to it with that same strategy, and it requires them to make a new strategy altogether. Whereas when you're on the discretionary side of that, it enables you to sort of not have to worry about having that sort of same strict criteria. And your flexibility allows you to sort of adapt very quickly to a changing market like we are seeing now. Now, the next type of traders sort of fall into the same sort of camp. You have algorithmic trading. So they are still technical traders, but algorithmic traders evolve from systematic methodologies. So since most technical trading techniques can be reduced down to a mathematical model, they can also be used in computer programs. So these programs can monitor current price. They might be used to program particular equations to make those sort of trading decisions a little bit easier. And then they might even manage the results of trading. So the use of computers in trading has become increasingly widespread over the years, and a product of the increasing power of computer and programming is likely used by both institutions and small retail traders, though the sophistication of the analysis and software and development and the computers used is vastly different. So if you were thinking of a quantitative analytics firm, or a quant firm as they're commonly known, they're using some very serious hardware with some very expensive computers and run full floors of different teams allocated to different types of strategies. And they may not just look at the price chart data. They might also incorporate rates and changes to monetary policy as a part of that data, and a variety of other things, and merge them all together to sort of evaluate on what they're going to do with their next lot of trading. Now, the next type of traders you'll commonly find are fundamental analysts. And fundamental analysis does not require a price chart at all. Instead, the analyst will examine the underlying factors that sort of affect price and then form a theory about whether that instrument will become more or less valuable over time. So once you've identified and built a theory has been formed, it's possible to compare a theoretical value to a real current value. And then the trader makes an assessment about whether the current price represents a good opportunity to enter the market or not. And having formed that theory about where price is likely to head, the fundamental trader will aim to take a position and hold it until the fundamental situation has become unfavorable. So to put that in real world example as to what's going on right now, we've got obviously the coronavirus. We have Boris Johnson, who has a coronavirus in ICU. We have a variety of countries in lockdowns. So from this way, instead of looking at data as to what's really going on, we're looking more at the emotional side of it and what the politics of it and how it might affect an economy as a whole. So in order to do that, we need to really consider what that economy is and build a picture in our head about that economy before making a theory about where the price might go when a significant event such as the Prime Minister of the UK going into hospital for a disease that is known to kill might affect the economy as a whole after if something was to go bad for him. So that's a different way of sort of thinking about the exact same data that we're really seeing. It's just that we're formulating an idea around what an economy might be doing as opposed to relying solely on the data itself. Now, the next type of trading that you can look at is something called social trading. And this is perhaps one of the newest approaches, and the results are not quite proven, but then also not unproven. The idea is that price will generally follow the direction of most traders. So, for example, if there are 1,000 traders and 700 have sell orders and 300 have buy orders, then it is more likely that price will fall since there are more sellers than there are buyers. Basic supply and demand, just like we spoke about a couple of moments ago. So the social trader is aiming to follow the group and trade with the crowd. This approach tends to move against the conventional wisdom that trading with a group leads to late entry, subsequent reversals, and usually against the position. Another weakness of this approach is that it ignores the fact that a vast majority of traders in the market is not hooked into this system. In other words, a social trading system only reflects a small subset of the market's current opinion. Commercial and institutional traders in particular provide the majority of trade volume. So when we're looking at that, they're not getting all the additional information that social trading forums might have. If we had the entire market participants involved, and that means we have institutions, commercial trading, we have hedge funds, we have all retail traders all plugged into the same social trading forums, then that would happen. But the chances are you would likely see that markets would just move sideways because there would be almost a perfect equilibrium of supply and demand at any one time. Now, the next one is what we call a bit of a hybrid approach. And each of the sort of approaches that I've given before will have their own advantage and disadvantages, but none of them have the whole picture. A student of trading who has knowledge of multiple trading approaches has the advantage of being able to analyze the market in a less rigid manner. For example, a fundamental trader might decide to buy into the market, but then wait for a pullback to a technical level to enter the position. So this would reduce the overall chance of drawdown or the total risk that they have on their exposure and maximize the profit potential. So in my own instance, I'm sure some of you are actually wondering what kind of a trader I am. And you are all likely wondering what kind of trader you are if you haven't really thought about these things before. Now, how do we sort of consider that sort of as an idea? Well, I'll give you a bit of an idea of what I am. I started out as a technical trader about 15 years ago. And I have moved my way through algorithmic trading, technical trading, both from a discretionary point of view and a rules-driven perspective. I have then moved into fundamental analysis and started assessing things in that way. I've never personally gotten into social trading, but that's more of my own ideas and ideologies. I suppose the closest you could say that I've ever come to that would be using sort of trading chat rooms and forums, or having been a moderator on a webinar much like this, except we were all able to post our trades. So that's as close as it gets to social trading for me. But these days, I consider myself to be a hybrid of really all of it. And as that category, I make it my own sort of name for it, which is rational trading. It's combining the best of both worlds. And in my perspective or my view, it is really best to be a part of each of these worlds, because when you have that ideology behind you, it's kind of like being the mechanic or the builder and taking your toolbox to go and fix the car or the house or build the house and the car, but only using one tool as opposed to using the collective of tools that you have at your disposal. So I tend to think of each of the different types or forms of analysis as a different tool to add to my toolbox that enable me to have a better outcome overall for my trading. Now, the next part of this is really, I'm trying to give you each time I get through a sort of section that I've prepared for you tonight, some sort of further exploration for you. So the information I've sort of given you has really just been the tip of the icebergs in defining or describing how each of these different approaches really work to profit from trading in the market. So I think it would be good for you all to take some time and do some research into each of these approaches and read about the technical trading and develop an understanding of the variety of tools that technical traders might use. read about the fundamental trading and develop an understanding of their tools and how they use them. Research the comparisons between the two approaches, and have a note that there are some traders that prefer one side or the other for different reasons. And like I've just said before, in my view, one is not superior to the other, and there are pros and cons to each of them. But you should form your own opinion about this because everyone has a different personality, and the way that each person trades is going to be slightly different to the next. So it is certainly important to take that into account. Now, the next section that we're going to be talking about is what the competition in the market is, who those participants are in total, and what you can sort of do to sort of work around some of the way that you might think about the supply and demand principles. So naturally, trading is a competitive auction process that involves different parties competing for orders. It, it is important to know who your competitors are going to be. And there's going to be a list of different ones that you start off with. So the most notable ones that most of you will likely be is retail and private traders. So retail traders are usually single traders who are working with their own funds or small aggregations of fund to trade. The size of accounts in the group will usually be small and sometimes as small as a few $1,000s, but you'll also get some that are much larger in the millions of dollars sort of mark, and they are likely trading for a variety of other people, but just in a small capacity. So as a single trader, you have to undertake all the activities involved in the trading process. This includes strategy development, fundamental research, trade implementation and monitoring, computer hardware, software expertise, and so on. The group sort of the list sort of keeps going. So as a group, though, the level of experience and education amongst those sort of traders tends to be quite variable. And overall, it tends to be much lower than what the other market participants are. And this is also the group where you find failure is the most common because of the lower levels of experience and the limited levels of education and the limited ability to actually access large quantities of funds. So when you do come into it as a retail trader, you are sort of starting behind the eight ball because you have so much more work that you have to be doing on your own than what you have to when you are competing against institutions. So in that instance, they are a little bit different. The institutional side of things, they stand in a very different place. They have large pools of funds. They have teams of people to perform specialist tasks for them. They have high levels of education, knowledge of the up-to-the-date second financial data, which is sometimes even beyond what I get. In order to have a Bloomberg terminal, for example, is about $20,000 per annum in US dollars. And that will give you up to the second immediate data, whether it be fundamental and all the others. Other aspects of that might be that you have your computer set up right next to an exchange to minimize your latency as much as possible when it comes to placing a trade. And they will also have very sophisticated computer systems using data servers with software development and research teams all just behind them. So trades originating from an institution can be large enough to sort of move the price of the market quite quickly, which might benefit their own trade. Institutions can lose trades, but their overall failure rate tends to be slightly lower. Now, in addition to this, I mean, like I said, each section I was going through, I wanted to give you some other things to sort of consider. And I want you to sort of think about your biggest competition, who it might be in the market, what the competition might be, whether it be institutions. I want you to speculate on what type of resources they might have to support their transactions. Include things like skills, access to research, inside information, computers, and so on. So there are a number of different sort of rules of thoughts when it comes around that sort of idea, and there are plenty of other instances to sort of think about it. Now, the next section that we're going to be covering into tonight, and I have prepared a few. I know it's a lot of information to take in at the end of your workday and quite late at night. I am trying to be conscious of that, knowing that it's also Easter. So I've really got another section here, which is more about what people are like as traders themselves. And so the next section is really about the personal attributes of an individual. And I haven't got slides for this. I am going to be just talking about it. So ignore my silly slide now. I might even just scrap it back to the very beginning one so it doesn't confuse anyone. And when it comes to sort of the lifestyle of a trader, there are many reasons that adding trading to your lifestyle will have a significant change to how you live your life. One change will be the large amount of time that's needed. Trading will involve reading, learning, researching markets, studying charts, planning trades, taking trades, monitoring trades, and reviewing your results. Not only is the amount of time a factor, but the actual time of day is probably the biggest factor, especially if you're trading out of Australia. And depending on the type of trading that you do and where in the world you really are. Your focus will need to be on the market at certain times of the day, and a trader must consider sort of these sort of times and what impact it's going to have on your life and how your life will impact on their ability to trade. So despite many markets being open 24 hours a day, the character of the market's movement isn't uniform. The market movement is dictated by the times that participants are most active and when price moving economic data is published. So for many instruments, this means that the market prices movement is not initially most active when European markets open. If it then reduces before the activity increases again when the US market opens 5 hours later. Activity levels then close off or levels off at the close of the US market, and it can be quiet until the European market opens again. As a private trader, you have to sort of consider when you're going to be making your trading decisions, and it needs to be when the market is obviously most active. So if you were to live in New York, you would have to consider, would you be able to devote time to trading each morning just before the market opens and for some time after? And so that means for, if you were living in New York, then, my trading day would start at 10 p.m. at night and I would go through until about 10 a.m. in the morning in a sort of a 12-hour stint. And you do that every day, Monday through till Friday. And then the other part is, would you be able to get up in the middle of the night if you are trading the European UK session? So some people, as opposed to trading from 10 p.m. till 10 a.m. like I did, they might get up at the 9 a.m. of New York, trade the New York session, do their day as per normal, or do whatever the activities they would usually do, go to sleep quite early, and then get up again at sort of 10 o'clock at night and trade for another 3 hours until 1 a.m. and then repeat the process. But this is obviously taxing on your body. If you live in London, you have quite a good opportunity because it means that your day will be 9 to 5. You'll be able to devote your time to trading each morning before market opens from about 8 a.m. And you'd be able to get back to the charts again when the US market opens after lunch. So it's quite a civilized way to work. Here in Sydney, however, you're devoting time just before the European market opens, which is about 5 to 7. I tend to start my trading day at the Asian session at about 3 p.m. in the afternoon. And I will basically watch charts until, just after the US working session, depending on what's going on. But this also, again, reflects on the style that I trade or what I might be doing. I won't be sitting at the computer the entire time nowadays, although once upon a time I certainly did. So it's obvious that, where you live has an influence on how you trade. It influences what time of day you have available to trade, the types of markets you can trade effectively, and the type of trading you intend to use. So if you are only intending to trade sort of ASX listed stocks, then your day would start at about 10 a.m. and you could be easily competing in that market. But if you're looking at trading FX, then your day really doesn't start until about 3 o'clock when you get the Asian session sort of coming into the European session, and you won't see much market action until about 5 o'clock. So if it is a part-time sort of a role for you after the sort of fact, then that would be a good place to sort of start. Sorry, I am losing my voice. So as an example, consider a short-term day trader. The short-term day trader would find it much easier working in the UK, like I said before, that 9 to 5 sort of gig, so that they would be working during daylight hours, which are aligned with your normal circadian rhythms. And this helps, with your alertness and your concentration. In contrast, someone in Australia trying to do that same work or those same sort of trading style would find it much harder to trade because it would require that they work from the early evening to the early hours of the morning when your alertness and concentration are much lower. The Australian trader, however, might find it easy to use longer term daily trades, which is what I do. So, in that sort of chart analysis, or, I might look maybe 2 to 3 trades per week. I'm doing it on much longer time frames. And I can look at stuff during the day while my concentration and alertness is aligned with my circadian rhythms, and it provides an optimal amount of concentration and memory for me to actually process what I'm doing. It also allows me a significant amount of time to sort of think about my actions. When you are doing short, fast movements, you don't have a lot of time. You have to be quick on the trigger. When you extend it out to being much longer time frames, you don't have that issue. Now, the next bit is really on personality and the trading styles that we've sort of gone through a little bit already. But it's essential to sort of understand that everyone's personality is different, and because our personalities affect everything we do, including whether an individual is suited to trading. So, for example, some people find risk taking any kind sort of challenging and uncomfortable, and could be described as conservative and safe. The trading is obviously a risky endeavor. So each trade is, can be a little bit more than a sort of a well-defined guesstimate at what you expect to happen. And it is the overall strategy that returns profits rather than each single trade. So people who are risk averse will find trading a difficult activity. But trading is a diverse activity, so it means that operating at different speeds requires different skills. Faster trading will be suited to someone who can make quick decisions under pressure without a need for a lot of analysis and confirmation, whereas an individual who prefers to analyze and make decisions and walk away will be suited to a slower approach of trading, like what I do. So while you are learning to trade, having exposure to a wide range of trading styles and techniques is really, really important. It includes the experience of trading at different speeds with different risk levels, but it also includes the different types, fundamental, the technicals, whatever else there may be in the spectrum. And it's as it's important as it's occurring, it's important to consider how comfortable the different approaches to trading affect the way you feel, and take note of how it makes you feel about it at the time, because eventually this might affect the type of trading you're actually going to do long term. So as a little bit of practice, it might not be a bad idea. Go and do that reading I suggested about the different types of analysis. Then give each one a little bit of a go and see what works better for you and what you'd like, and how you feel about it while you're in a trade. If you're feeling anxious in the middle of it, then it might indicate that you might be better off looking at a different type of trading style. So, and there are other aspects of this that can be issuance as well. So you will find there are a lot of people that, say that trading is portrayed in advertisements as an easy path to acquire wealth and freedom from 9 to 5 jobs. Some of the ads will, give you an opportunity to undertake to learn to trade, and give themselves and their families a promise of a better life. It really suckers in to the greed factor of what people are wanting to have for themselves in terms of their financial well-being. And others will respond with suspiciousness and doubt if it can really happen and if it's a scam. But it is possible as well that both are right. Some educators provide courses which purport to teaching someone to trade. And in my experience, these programs teach useful information, but the exposure is limited and way too limited to provide enough information for, you to actually succeed from one strategy. So the course material might be valid, but you need to have the participants have a higher likelihood of failing because they haven't had the full experience of that person. So even if you were to go to something like knowledge to action or some level of education program, generally speaking, they teach a few simple strategies that fit in for the one size fits all approach. And really, you need to have the full range of experiences, and you won't get the understanding, the wisdom, or the experience. The educator, however good they may be, even myself, can't pass that sort of 10 or 15 years of experience on to you. So it does come from a lot of experience as well as the educational aspects of it. So the failure is really interpreted as ends up feeling like it's your own fault. And then you're left with a negative feeling about your own ability. And this becomes just generally a harmful experience. So if you find yourself in a situation where you want to trade, but also experience negativity from those around you, then you will need to find a solution. The solutions will be different for different people, but some of the suggestions that I've heard over my years, and from some other people that have had sort of struggles with it, and other people that I've taught, are that gain the understanding of the people that don't believe in what you're doing by explaining what you would like to pursue trading as an interest, or if you like as a hobby. This way they won't be as concerned that you're sort of chasing something that may not be always realistic. Instead, it can also be good to consider a keen interest like any other keen interest, which is good for someone as well. Also, don't present inflated versions of large gains based on advertising or slogans from what you've been told. If you see an advertisement that says, "Could you be my next six-figure student tomorrow?" the chances are that is not going to be the right way to go about things. Trading is about consistency. And now, if you look in 2008 at what the world's best hedge funds actually delivered, some of them were lucky enough not to lose a great deal of money, and some of them were lucky to make about 1% that year. So when it comes to what we look as performance, investors tend to prefer, especially if you're going after an investor to sort of help fund your capital, investors tend to prefer seeing consistent, smooth results on the graph. They want to see a line that goes from the bottom left to the top right without too many divots out of the way. So they will look to see if you have a drawdown of no more than sort of say 5 to 6%. Sometimes they'll be willing to accept up to 10%. But at the same token, they want to see you having good progress. And generally, what I mean by good progress, my targets, my personal targets for a monthly basis are about 2%. So if I have a really good year, I'm aiming for about 20% by the end of the year if you take into account your holiday seasons and stuff like that, taking out trading days for us. Now, if I was to only get 12% per annum, I'm okay with that because it means I've actually beaten the leading index for that year. So usually I compare myself to the S&P 500 and what the results could be for that index. And that's a good way to start. A lot of people walk into this with the realization or the feelings that they can turn $10,000 into $100,000 in 12 months. Now, yes, it can happen, but from my own experiences, it's not generally the best way to go about things because if you have really big wins, chances are you'll also have really big losses. So even if you have that optimistic ideas about a future with trading, don't overstate the ideas. And sometimes those ideas might sound unrealistic. So if you get delivered a education program or some of those lines, and remember, like, so now I do this sort of stuff for free. I'm not charging anyone any funds because it's part of like what I do for my job. But you need to understand that if you do get stuff like that happens, then understand that if you have questions about what might be considered realistic, or an education program says you can do this and it just seems too good to be true, the chances are it probably is. The other aspects to sort of consider when it comes to sort of beginning out, a lot of guys who are out there that sell educational trading robots and indicators that will help you to sort of trade, the algorithmic sort of trading sort of stuff. Now, the one thing to always ask yourself and to ask them if they're trying to sell you a product is to go, if you are making money out of trading this, then why are you trying to sell it to me? And you have to really consider and ask yourself the question, why is someone trying to sell me a product that reckons it can make $100,000 in a very short period of time for a couple of $100 or a couple of $1,000, when the reality is it'd be much better invested to actually use it. So that is something to always consider on. Now, when it comes to sort of personal attributes and how people trade, this is going to be the last sort of set of sort of places for you to explore that I'm going to give you tonight, and then we're going to move into sort of question time if any of you have any questions. So if you have questions, start thinking about them now. The chat box is open so that you can put them in there, and if you have something particular, I'll try and answer it as best as I can. But when it comes to sort of further exploration, when it comes to personality style and what your trading types might be and your lifestyle, consider the time zone that you live in and work out when the markets are going to be most active in the context of your trading day or your work day. It'll be easier if you can consider the markets that are most active during the sort of period. So for example, if you're in London, then 8 a.m. to 11 a.m. If you're in New York, then you're going to have to look at being up quite early and then up again quite late. And then if you're in Tokyo, a different time zone altogether again. I want you to then consider how trading might affect your lifestyle, and also consider what your considerations are going to be like at those sort of times, what your concentration is going to be like at those given times, given the impact on sleep and wake cycles. And then reflect on the personality style sort of things. Do you like to see results quickly? Are you prone to losing concentration easily? Are you very analytical? Do you tend to freeze up if you need to make quick decisions? Do you get anxious when you're under pressure? Are you even tempted and accepting, or are you more in the get disappointed and emotional when things don't quite go as planned? And these sort of things are not indicators of saying whether you can or can't do trading, but they will influence on what sort of trading is going to be better for you and whether you're going to be a fundamental, a technical, a day trader, an intraday trader, or a much longer term sort of thing. So please take all of those sort of into account. Now, if you have any questions, throw them in the chat box. I will leave the window open for about 5 minutes. And then after that, I will bid you all a happy Easter. Okay, so one of the questions I've had has come from Jason G. Hi Al, it'd be good to do a webinar on the psychology of trading. I used to think it was not important, but I have become more interested in this topic because it really affects decision making. So Jason, I actually do a webinar on the psychology of trading and quite in depth. And I take a lot of the stuff that I've actually giving for psychology from not only personal experience, but my co-author of my book, Essentials for Trading Students, which I wrote a number of years ago, was a textbook for a sort of college service. He was previously a psychiatrist, and who had turned into a full-time trader. So he spent 25 years as a psychiatrist and then about 20 years as a trader, and then probably about 30 years as a trader now. So a lot of his psychiatric and psychology sort of side of things have been applied into our book. And I do use a few transcripts from that whilst I'm reading and talking to all of you and a lot of the takes on it, plus also the aspects of it. So we do have more on that. If you go to the FinLogix, you're able to go into the FinLogix ACY Cloud and you'll be able to look in. And if you can actually see on the right-hand side where it's got the online trading, the title for the psychological session is What's Up, Doc? Psychological Management When Trading. So you are welcome to sort of log into that. And of course, routinely check into these sort of things at the ACY website under the training, either in the cloud or through FinLogix, and you'll be able to get a good idea of what's going on. As well as the blogs that I write. I write a number of blogs and also do video market updates and stuff through our website and YouTube and a variety of other places. And some of those incorporate those psychological aspects. So the most recent video I did today, I believe, was on the elements of actually trading from home and some of the challenges that you might not expect to find, but do often quite find, especially when you're doing it for the first time ever. So feel free to sort of have a look into that side of things. And when you go into the trading education sort of thing, this is how you will see it. It will come up like this. And it usually shows my next sort of, see the next 6 webinars that are going on. The website for it is on there. So Jason, if you're having a look at the screen that I've got up there now, it should be on the, oh, you can't see it on the ACY Cloud. I'll have to get that checked out for you, but it certainly is at the web page I've got on the bottom of the screen here for you right now. So if you go there, you'll be able to save it and have a look, and they will regularly come up. That webinar particular may be a couple of, it might be about 2 or 3 weeks away. It just depends on what they've got it, when we've got it scheduled. But I can certainly chase it up and find out an exact date for you. Nicholas has also asked, for the rest of you who are still in the chat, what charting software do I recommend? Well, charting software is a very big can of worms. I could actually probably do an entire session just on the charting softwares that are available. I have worked with a variety of them over the years. Obviously, MT4 and MT5 are the simplest because they're cheap, easy, and free if you're trading CFDs. I've used things like E-Trade and Thinkorswim for dealing with US-based stocks and when I was living over there. I have worked with eSignal, which is a very good program to use, but it is expensive because you have to pay for the data feeds on a monthly basis, and it usually costs about $300 a month, I think, to get all the data feeds that you need. Obviously, there are trading programs like CTrader and Cialgo, which are more on the professional spectrum of things, and they tend to operate with buy-side, sell-side software for quantitative firms and hedge funds. And then you've got things like FinLogix, which is what we offer here at ACY, which is more on that social platform side of things. And then you also have things like TradingView that you can also use as well, which is sort of on that cloud-based sort of spectrum. Now, there are a variety, there are as many sort of software applications as there are sort of, markets to trade in. The The most commonly used ones tend to, if by retail sort of market stuff, tends to be MT5 or MT4. Of the two, I tend to prefer MT4 because I'm a little bit, if I'm going to be dealing with CFD based things, I tend to use that because it's one I'm most familiar with. But if I had, free reign and I wasn't so worried about what I was doing with it, then I would always use eSignal because I can keep everything in one platform. So I can look at my stocks and shares, my ETFs, my commodities channels, and everything all on the one platform. So as a recommendation, I've got my own eSignal accounts and I love using eSignal for a lot of my charting purposes. But if for someone just starting out, it can be a little bit on the more expensive side to use. So I hope that sort of answers your question a little bit, Nicholas. Now, moving on from the sort of stuff that's going on now, if some of you haven't been here before, I do offer an email service where you can ask questions, and sometimes I will respond directly to you, or perhaps if I get enough interest in a particular question, I'll make a video and put it up on our YouTube channel. And I'll sort of do a sort of 5-minute or a 10-minute tutorial that keeps it quite simple for people to use. So if you want to get in touch with me and ask some questions or anything like that, then feel free to. The next webinar that we have, and every Tuesdays I do these webinars, is a bring your own charts day. So if you have a chart that or a trade that you were looking at and you were thinking about and you would like me to give you a second set of eyes or a second opinion, then you're most certainly welcome to join in on the webinar. And generally what I'll do is I'll look at the Aussie dollar and the ASX 200, see if we can find any patterns, have a talk about it from a technical side of things. Then I'll move into a fundamental side of things and sort of talk about the general ideas around it. And then I give the opportunity for people to send me some charts to have a look at. And I try and do my best to sort of help guide or put some perspective into what might be going on in that particular market. Now, as a caveat to that, I do know most markets and I can look at most things. There's not really anything I won't look at from a technical perspective. When it comes to the fundamental side of things, I think the most recent one I got was about the dollar try, which is the US dollar versus the Turkish lira. And I'm very comfortable talking about the US dollar side, but the Turkish lira, as it's an exotic pair, it's not one of my common ones that I would pick to go and have a trade with. So, naturally, I will always do my best to try and cover it for you. And if I don't know about it in the session at hand, I will always do some research on it. And so I have since brushed up on my Turkish lira and Turkish politics to sort of give you guys a little bit of extra hand. But that's all it's going to be for tonight. I don't think anyone else had any more questions. I've answered quite a few of them already. I'm not seeing anyone else putting new ones in. It is going to be Easter tomorrow, so have a happy Easter, everyone. And I would look forward to seeing you all next Tuesday. Otherwise, I'll see you then. Bye for now.